vibration that led success so high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Reserve Bank of India is trying to make the payment space more competitive. After granting an in-principle nod to the likes of Razorpay and Innovity, the central bank has opened another window till September for companies to apply for a license. In 2020, the central bank issued guidelines that said only firms approved by the regulator could offer payment services to merchants. Good morning, my name is Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we'll discuss the results of the BS poll on rates before RBI's meeting and the central bank allowing banks to show credit card details till January 2023. We have an interview lined up with Tapan Singhal, MD and CEO of Bajaj Allianz General Insurance. Our Banking for You section explains what account aggregators are, and our banking expert Tamal Bandyopadhyay explains the rationale behind his forecast of a 50 basis point rate hike. We have a question for you at the end of the episode. Starting this week, we'll start a poll for you to send us your opinions about the banking developments. We'll discuss the responses in our next episode. So stay tuned. Here are the significant developments of the week. With the RBI MPC meeting ending on Friday, all eyes will be on the central bank. Will it take its foot off the accelerator or front-load rate hikes? In the last fortnight, Fed raised rates by 75 basis points and the European Central Bank instituted its first rate hike in 11 years. A BS poll of 10 economists found that RBI may go for a 35 to 50 basis point rate hike on August 5th. So far this year, the central bank has raised rates by 90 basis points. Card tokenization is another issue that the markets are keeping a close eye on. Last week, the RBI allowed acquiring banks to store card-on-file data till January 31st, 2023, giving more time to companies for tokenization. However, all other entities in the value chain will still have to purge all card data by October 1st. The central bank had granted yet another extension to companies on card tokenization in July. The central bank took another momentous decision last week as it concurred with the centre's position to permit non-financial institutions to own more than 40% in IDBI Bank. The push comes at a time when the government is looking to fast-track its divestment of IDBI Bank and push for divestment of two other entities. In an interview with Business Standard, the finance minister had said that the government would go ahead with the privatization, but it is yet to take a call on the best way forward. Entry of non-financial institutions is likely to give the government more room for its divestment. Talking about private banks gaining more hold, the Competition Commission of India approved the Citi Axis deal. The deal involves the sale of consumer banking business of Citibank India, which includes credit cards, wealth management, consumer loans, and retail banking to Axis Bank. The banks had announced the deal in March, marking the exit of India's oldest foreign bank from its consumer business. It is not only the banking sector that is changing. The insurance sector is also set for an overhaul, with IRDAI suggesting changes. In a conversation with Business Standard Subrata Panda, Tapan Singhal, MD and CEO of Bajaj Allianz General Insurance, discusses the company's performance in the first quarter of 2022-23 and its post-COVID impact on the industry.
Bajaj Allianz General Insurance has reported a net profit of Rs 411 crores, up 14% from the corresponding period of last financial year. Its gross written premium increased by 25% during the same period to Rs 3,119 crores. To talk more about the company's performance and the industry in general, we have with us Mr. Tapan Singhal, Managing Director and Chief Executive Officer of Bajaj Allianz General Insurance. Welcome to the Business Standard Banking Show, Mr. Singhal.
My honor, Subrat. How are you?
All good, sir. So, how was the first quarter for the company, given this was the first quarter where we didn't see any restrictions because of COVID-19?
So I think let's talk about the industry first, overall, the impact of what's happened post-COVID, how things are moving, how the industry moves, and I'll talk about the company also a bit. So generation industry across the globe, not only for India, the big issue is the inflation. So you look at the inflation movement has happened considerably, in terms of now how do they affect general insurance industry? Be it for motor claims, you would find the cost of repair would move up because of inflation. Be it health claims, the cost of health claims will move up with inflation. I mean, something simple like a factory reconstruction, all the steel prices, cement prices, with all of it moving up, the claim cost for the industry would move up. Now, when the industry does the pricing, this sudden blips, I don't think they're able to account for that. So the most interesting thing post-COVID is high inflation, and across the globe, for the entire generation industry across the globe, this would be a huge problem in terms of the claims cost moving up significantly compared to what the pricing had been done earlier. Now, again, because of a low base of the COVID times, I think growth looks very good for the GI industry. Having said that, if you look at the industry, it also has always given a double-digit growth. Even COVID times also it was growing. Now it was a negative growth. It had some small positive growth. It was growing. So the good part of generation industry is, if I look at the way the economy of the country is going, the way opportunity is there, this industry will keep on growing well, which will be there. But the thing to worry or watch out for is the inflation impact on the generation business in terms of the claim cost moving up, and how does the industry look at pricing it going forward. I think that is what the issue is. Now, if you look at our company, I think we have maintained what we always do. We try and capture, and grow over the market, and we also try and ensure that we are able to have a very good, profitable book, because our philosophy has been companies with strong balance sheet are the ones which are able to serve customers very well. Now, if you look at, and these are publicly available data on IRDA website, the grievance ratio for a company has been least for if I may take back from the time when it was published, maybe a decade or so, every quarter has been least, and we have the highest solvency ratio, close to 350%. So a company with strong balance sheet is able to serve its customer very well. I think there's a clear correlation on that basis. So we have maintained that philosophy. So what you look at our quarter one results actually is what our philosophy has always been, to try and grow over the market and have a strong balance sheet going forward.
If you look at the General Insurance Council data, it suggests that retail health has slowed down from what we saw in the pandemic. Now, group health is the reason why we are seeing a growth in the entire health portfolio. What is your assessment of this issue? Why has retail health slowed down?
It's a very good question. Now, let's understand first and foremost group health. Now, group health is an annual contract, in most of the cases. And the price revision happens whenever the contract comes up and is due. Yeah. So as I mentioned to you, with the cost of COVID and the health claims ratio moving up because of inflation, the price correction of group health will happen. So when you look at the group health growth, you should figure out, is it more number of group health being added, or is it a price correction which has happened? Predominantly the growth is because the price correction which is happening in group health. That is why you see higher growth. In retail health, the price correction does not happen like this. You have a 3-year lock-in period, which was there. So people would have to take time before the price correction would happen in retail health. Some companies have increased the price, and you see a growth in those companies, balance sheet, which are a price increase there. So fundamentally, the base effect of corona products which were there last year, one would be that. Second is the price increase, is why you see this differentiation. So it's another group health has moved up in number of policies. I think the price increase which shows a higher growth compared to retail.
Now, if you look at the data closely, we see that the general insurers have just grown by 2% year on year when it comes to retail health. But I mean, the standalone health insurance companies have done fairly well. What is the reason behind general insurers growing so slowly?
Again, we understand that if I look at the Sahi companies, as we call standalone companies, they have a certain advantage. One, in terms of agent procurement. So they don't have to, they need not license agents as they procure. They can work with agents which are working with life company or general insurance company, And the same is not available to general insurance industry as a whole. And insurance is still very distribution-led. So any company which can create distribution at a much hyper speed will also have a growth rate which is much faster than the other part of it. And that's why it's such a good question that you have seen. The Sahi companies have a clear advantage in terms of being able to procure agents, at a much easier pace compared to what the insurance industry could have done. And that is why I think since they could build a massive distribution at a very short time, the multiplication numbers is what is clearly visible, which is there. So I think that is one predominant reason. Otherwise, you look at products, we'll look at, in terms of the offering, I think the insurance industry also offers a very, very good basket of products. It offers a very good service network. It has a very comprehensive hospital network. So on those parameters, I don't see them anywhere lagging, if not stronger, compared to Sahi. But I think the advantage of distribution to Sahi is what gives them this unique positioning of being able to grow business faster than insurance.
You spoke about use and file procedure. I mean, the regulator has permitted the use and file for almost all products of general insurance industry.
Yeah.
How do you see that helping the industry going forward?
It's very exciting. I think it pushes innovation, it pushes customer centricity, it gives flexibility. So smart companies will be able to use it very well, and it will actually enhance customer experiences. A lot of good products would come through, at a much better speed. So I'm super excited about it.
The last time we spoke, you had told me that you are looking seriously at the surety bonds business.
Yes.
But there are certain concerns which you had, which the industry had spoken to about to the regulator and the government.
Yeah.
So have you had any clarity on that issue so far, or is there any update?
Yeah, so we have still maintained that the recovery right has to be there for any business. If you look at it, there's no recovery right, then it gets into a bit of a difficult stand, and that is why it's taking a bit of a time. From surety bond perspective, I'm very, very clear that we are set to go. I think we have also the policy wordings with us. We also have a kind of the basic framework ready, which I mentioned to you last. And this clarity has to be there. Otherwise, you run into a business in which you have no recovery rights or a civil suit, which takes a long time to be able to fulfill that. Then from a risk perspective, it is not appropriate. I think we have raised it to the government and the regulator on these points and mentioned about it also. By the same time, we're still working with reinsurance, looking at what is the next alternate best method that we can look into it. So it's something that we're not leaving so easily. But at the same time, yes, on a very fair basis, the demand remains, the recovery right has to be very clearly established from an insurance company perspective.
There have been some talks with the insurers that the obligatory cession that general insurers cede to GIC rate, that can be done away with. What is your view on that?
See, the issue is not about cession. The issue is about the insurance industry getting the cost they incur for procurement of business. So it is not an obligatory cession. It is the kind of commission which gets paid on obligatory cession is much lower than the cost incurred by insurance company for procurement of business. So in a way, for that particular business, at day zero, an insurance company makes loss. I hope you understand, Subrat. So it is not about obligatory cession. It's about, let's say this obligatory cession is about, let's say, whatever percentage, and what you get as the cost, for placing that business is lower the cost you spend on procurement of business. So day zero, you're losing money on that. And that is what the demand has been, that either it has to be on a fair play basis in terms of the cost spent by insurance company that has to be compensated for in the obligatory situation, or do away with it. Why should there be a position in which insurance company loses money, by placing an obligatory situation? That is what the issue is.
In the recently concluded IRDA board meet, they have proposed to put a limit on expense of management for general insurers. How will this impact the industry?
I have always been a champion of low expense. Fundamentally, if I look at the perspective of a policyholder, how much does a policyholder pay for expenses which is not part of claims? I think that is something that should be there. So I personally welcome any move which is on limiting the expense of management. Because the company in today's time with digital technology, with good distribution network, with the presence which is there, should be challenged to every year reduce the expense of management, because that is good for the policyholder.
Coming back to the company, sir, is there a plan to increase the proportion of health business in your entire portfolio?
Yes, when you have 70 crore uninsured Indian, and for a dominant company like us, not to have a plan to keep on increasing health insurance to cover every citizen of India would not be a very good thing to have. So we are very clear that we keep on pushing health insurance as we move forward.
Is there a target in mind? What kind of proportion you want?
Yes. So what we actually do is we look at different segments. We look at, let's say group health segment or government health insurance or retail, and then what segment of retail health, an HNI or a mass segment. So we have clear targets on different segments which is there. And we have very good products for each segment. So I think, we position it like that. And then we push on each of it. So that is what is very clearly established.
Also, is there a plan to grow inorganically also by acquiring any small company to increase your market share?
Two views on this. First, this is a very good question to the wrong guy. It should be asked the shareholders. Second, from a personal view, if you ask me, when I look at inorganic growth, it has to add something to the insurance company that, let's say Bajaj Insurance Company in case. If it adds distribution or if it adds, a different line of business or product of business, some specialty which is there or some special skill set, it makes sense. Just to have a macho feel to acquire companies, from my perspective, that's not the way I look at it. But obviously, it's a question for shareholders to look at it and figure out what would be their strategy on that. But I look at inorganic acquisition only when it adds value to the company. Then it's a long-term strategy that you have. That's my personal view.
That's all the questions I had for you, sir. Thank you so much for joining us on the show.
Always a pleasure, Shubhrat. It was always a pleasure talking to you. Thank you very much.
Thank you so much for your time, sir. Thanks a lot.
Singhal says the big issue for the industry is inflation, as claims costs will increase significantly, which has not been factored in. He also points out that the quarterly performance indicates the company's philosophy of going over the market and having a solid balance sheet. Meanwhile, the central bank is going with the philosophy of competition and openness to promote digital products in the country. It has been pushing for account aggregators. In our Banking for You section, our experts explain what account aggregators are.
Account aggregators, AAs, are licensed non-banking finance companies that enable the instant exchange of financial data between financial information providers, FIPs, and financial information users, FIUs, with the explicit consent of customers. FIPs are entities that possess the financial information of a customer. These are banks, mutual funds, pension funds, etc., representing the source of personal or business data that FIUs can access via request through an AA. And FIUs are entities that want to use this data to offer financial products and services to their customers. To sustain the ecosystem, an FIU also must be an FIP. The account aggregator ecosystem went live in September last year, intending to democratize credit delivery and bolster the lending ecosystem. Are these data transfers safe? AAs are data blind. The data that flows through it is encrypted and can be decrypted and processed only by the FIU for whom the information is intended. Moreover, according to RBI's master directions, an AA cannot store any user's data. Thus, the potential for leakage and misuse of user data is minimized. So far, 19 banks have gone live on the AA ecosystem, and more are expected to go live shortly. Around 0.97 million accounts have been linked to the ecosystem during the last 11 months, and about 0.93 million consents have been given during the same period. Sehmati, an industry alliance for the account aggregator ecosystem, is now working with Securities and Exchange Board of India entities to get them onboarded. It has also started work with large insurance firms and is in talks with the GST network. Initial discussions have also taken place with Life Insurance Corporation. 6 account aggregators in the system have received the Reserve Bank of India's approval. 8 more have received an in-principle nod from the regulator.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The purpose of account aggregators would be to enable the instant exchange of financial data between financial information providers and financial information users with customers' explicit consent. The immediate concern for the industry is the impending rate hike. While a rate hike is imminent, our banking expert explains the conditions leading to the rate hike and the rationale behind the expectations of a 50 basis point hike. Hi Tamal, thanks for coming on the show again.
Thank you.
Now the RBI meeting, MPC meeting is going to conclude on the 5th, that is this Friday. And you talk about the issue of soft landing for the economy, and you also mentioned that RBI governor also mentioned it. What do you perceive would be a soft landing for the Indian economy in this case?
No, which Reserve Bank of India governor himself had said in a recent speech in Delhi. So essentially, what I think his way of telling the market that there won't be any nasty surprise. There was an off-cycle meeting before the last MPC meeting. It had to, in response to the Russia-Ukraine war and the rising inflation. So he had to have an off-cycle meeting and push the rate up, and then again it was followed by yet another rate hike. So that is sort of a nasty surprise for the market, because till February and even beyond, Reserve Bank of India was giving the impression that everything is under control. Our inflation is not a big worry. The nature of our inflation was very different. It's supply side issue, not a demand issue. And we are sort of decoupled from the rest of the world. But that's not the case. In fact, if you look at the inflation number that was projected in February, I think even had there been no Ukraine war, but still that was very, very low from the reality. And incidentally, Reserve Bank of India often goes wrong with the inflation numbers. It's on the other side. It's always downplaying the numbers. So I think by soft landing, what Reserve Bank of India governor meant that there won't be any surprise. It will be a par for the course. We'll move ahead with hikes probably, but in a gradual fashion.
Now, you are rooting for a 50 basis point hike this time around. Why? And why do you believe RBI needs to front load hikes if the Fed is seen to be easing? It was supposed to raise the rates by 100 basis points, but it did it so only by 75.
There are two parts to it. Let me take the second part. Is this? I think many of us are not exactly understanding the scenario in the US. You need to, we are all aware that the election round the corner by the end of the year, and the single point mandate for the US Federal Reserve is to contain inflation, period. So I'm afraid I don't think US Fed is going to put a brake on it. Yes, it was not 1%, but 75 basis point. But that doesn't mean that Fed will slow down. Can India afford to lag behind? And there comes the first part of your question, 50 basis point. As we speak, there are three schools of thoughts. One is rooting for 35, which will take it to 5.25. One is rooting for 25, which will take it to 5.15. That's exactly the pre-COVID level.
Yes.
But I am a great believer, or I belong to that camp, which I personally feel that RBI should go for 50. And if you want really for if you wish for soft landing the economy, you need to front load your action.
Can you explain why India needs to keep parity with US rates to keep the rupee stable? Because this is something that you mentioned in your column as well.
It's very simple fact. I mean, it's so like water flows downwards, money flows upwards wherever there's a higher return. So if US is hiking rates, so naturally the money will rush to US. It's not that the Indian currency has weakened. All the global currencies have weakened. Most of the global currencies have weakened because the dollar index is going up. So we have to match the US thing, but the gap has to be maintained. I mean, if the gap widens, then certainly we'll be in trouble, and which had been the case. Rupee cost 80, but it is retraced. But as we speak, yesterday's trade deficit number, and if that's the trend, import bill is going up. There's virtually export is stagnant. So in that case, there will be pressure on rupee. And if the rupee starts falling, then the importers wait to bring their money back, exporters rush for hedge, and that creates more complications for the currency. So ideally, we should raise the rates, not in tandem with the US, like 75 bips by US, so that we should also go for 75 bips. But the gap between US rates and Indian this thing has to be maintained at certain level.
Inflation and rupee depreciations. What revision do you expect on the CPI and GDP numbers in the RBI's forward guidance? IMF has revised GDP downwards for India.
Yes, IMF has revised GDP number for the entire globe, including India, but still India continues to be one of the fastest growing major economy. So I think we are better off among the emerging market economics. We are better off. So there are pockets of hope, even though the growth is not yet solidified, but certainly we are better off than many of the emerging markets. I would like to believe RBI may not give any guidance on growth and inflation at this point of time. It will act and will explain its action, and then maybe in the next policy we will see. For the time being, probably, because our impression is this growth probably may come a tad lower than what RBI has assumed, and inflation also, incidentally, good story, may come a tad lower than what RBI has assumed. But will RBI commit itself again? Because RBI has changed the inflation number thrice since February. So can it afford to do that so fast and then again change? I think it will wait and watch, and probably in the next policy we'll see if at all it wants to change anything.
Do you foresee rates going beyond 6% this year?
No, I would not. For the simple fact is this: if you see the RBI's latest inflation projection, the fourth quarter number is 5.8%. That's by March 2023. So that's the 1 year projection, 5.8%. And now the trend is probably it will be a little less than that, 5.5% or so. So, all of us have been talking about the real interest rate, which means we need to push the rate up higher than the 1 year down the inflation projection. So if it's 5.58%, actually relates to 5.5%. So ideally it should be 6% interest rate. Then you get a 50 basis point, 0.5% real interest rate.
Yeah.
But will RBI be in a hurry to do that? I'm not very sure about it. Fiscal year probably could be by 6%, but definitely not calendar year by December. I think it will keep a watch, and that's the question of nominal interest rate. Basically, you need to take the interest rate in a positive zone, which can be done only by raising it beyond the 1 year down the line inflation projection. So ideally, it should be 6%, but will it do it? I would like to believe RBI will be equally concerned about growth, so it will go slow.
Thanks, Tamal. Thanks for coming on the show. We hope to have you back again. Thank you.
Thank you.
Tamal believes that the only way to protect the value of the rupee is not to allow the gap between the US and Indian policy rates to widen. As we discussed at the start of the episode, we have a question to ask of you. We would appreciate it if you could answer it for us. We shall discuss the results in our next episode. As discussed in our banking wrap, the government is finding ways to fast-track the bank privatization process. But should the government go ahead with its plan for privatizing PSU banks? What do you think? Yes or no? That's all for this week. We'll be back next Thursday with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.